Hi, guys. It's Chad Larson with MLD Wealth. This is September's Money Matters. Uh, as always, a couple days into the week, and we're just after the Labor Day weekend here. Everyone has stuffed themselves back into dress shoes. If you're still a working stiff like myself, the lake's all packed up for most, and summer holidays seem like they were a million years ago. Always feels like a little bit like a new year. Ever since I was a kid, I always felt like September was the start of the year. It was the start of a new grade, a new adventure, a new chapter in our lives. This one hits a little differently for me. I just got back last night, taking both of my teenage kids off to school on the island, and so I'm an empty nester now. Last night was the first night. Transitioning into an empty nest lifestyle, and I'm not gonna lie, it wasn't wonderful. It was very awkward and very quiet. Spaces feel really empty when family's not in there. So no tears for me. Those were all shed yesterday in the solemn drive to the airport to leave them behind as they pursue their new adventures. But rooting from the sidelines as their biggest cheerleaders. So shout out to them. But pray for mom and dad here, because this will be an adjustment for sure. Anyways, lot to unpack. It's not a word I use lightly. It seems like it's thrown around in boardrooms all the time, in meetings. But what happened in August? August was a wild month. We had a sharp correction in the market. Really, tech hurt the market and really caused a lot of the bullish thesis to start to wane. Much like when we go back to even January, and we're now in the ninth month of the year, like we're in the fourth quarter. We want to look at our thesis and see how it's played out, and was it right, and have we adjusted along the way. Couple of key things. When I go back to our January podcast, I said we expect like exuberance into the front part of the market, as the market overly expected the Fed to start cutting rates aggressively, and that really lit a fuse to a resurgence of a tech-led economy into the United States, and is AI mania and NVIDIA and the few other tech names really leading the charge and dragging the markets much higher. But I've always been cautious to talk about that we saw 2 years of muted stock performance through 2022, and even with the strong resurgence in 2023, that really kind of got us to even Steven when we started the year. So that first front of the market was just the smoldering of a bull market trying to start itself on the tail end of a tight fiscal economy and higher interest rates. That's a lot of word soup, but we thought that we would see eventually. Some of the concerns we had was a very narrow market. It was just really the Magnificent Seven, and a small portion of the economy doing all the heavy lifting from a stock market perspective. We made a tactical shift almost to the day. You got to get lucky every once in a while, or good to be lucky, and shifting a lot of our exposure to more of an equal weight. We really wanted to not reduce our exposures because we were negative those sectors, but a bird in hand, and secure some profits into the front half of the year, and take a broader approach to sector exposure. And so that's played out incredibly well thus far. What we did expect is that we thought into the end of the year we would see some choppiness, and I've been talking about turbulence into a seasonal weak period of the market, into an election cycle. We did expect in the fall volatility to rise. Well, it came in August, so it came a little bit early, and that's okay. We're prepared for it, and ultimately, 1 week's performance or 1 day's performance extrapolated is enough to cause anyone to throw up under their desk. But we're positioning capital for long term over market cycles. So things happen as we expect them to do. Sometimes they happen a little sooner, sometimes they happen a little late, and that's why I've always resonated. Portfolios are much like taps. They're not like light switches. You can't turn them on and off. And we go through a really interesting academic and emotional and spiritual adventures, when allocating capital, depending on the liquidity at hand. But we have to frame things that over the long period, when we look at some of our tailwinds, which I'll say again, our tailwinds are still intact. We have an easing Fed and an accommodating Federal Reserve. The Bank of Canada cut Wednesday for the third time in a row, lowering its key interest rate by 25 basis points, simultaneously opening the door for bigger cuts if the economy slows more sharply in the months ahead. And the Fed is the U.S. Fed. It's imminent. We're expecting it next week. Traders, they held them higher for longer, which was like an acronym or some verbiage that had been thrown around through the front part of the year. people got a little bit ahead of themselves, but they really wanted to make sure inflation was in check. But all signs are is that the Fed will cut. And some interesting comments I want to get into. But before that, I want to talk about the yield curve. I hate talking about it. It's truly at its core, it is nerd speak 101. You can't touch it, you can see it, but there is some causality and effects of how that impacts capital. But the yield curve and the relationship between the 10 and 2-year treasury yields flattened on Wednesday, reversing what was historically been a classic recession indicator. So things have calmed down a little bit. So following some economic news that showed a sharp decline in job openings and some dovish remarks from Atlanta Fed President Raphael Bostic, the benchmark 10-year yield inched above the 2-year for the first time since June of 2022. Political volatility remains at the forefront. We are in an electoral cycle into the U.S. and potentially even faster in the U.S. Or in Canada. I think over the weekend or 2 days ago, the NDP have signaled kind of a retrenchment and a pull away from the Liberals and kind of breaking up their coalition government as the Trudeau government is now historically the most unpopular prime minister Canada has ever seen. So great. So political volatility. Let's talk about September. From a market perspective, September sucks. Maybe that'll be the title of the podcast. Since 1950, it's had an average decline of 0.8%. But September's poor history it's hard to ignore, but the market also has a lot of things on its side. So you can't just run away. And that's really kind of the thematics of it is you can't go gas, break. Capital is fluid. There's tax implications. There's liquidity components and timing. The age-old adage is time in the market far outperforms timing the market. While many investors have waited for 2 years waiting for a sharp correction, the market has surged like 40% in the S&P alone. So you got to be kind of pragmatic about it. Understandably, when you're parting with that hard-earned cash, no one likes deploying a large sum of capital and get bonked on the head the next week with a sharp decline. But if you're congruent and consistent in deploying capital, it's hard to argue that any capital put to work here 3 and 5 years out isn't worth much more than sitting there rotting against inflation and cash. But September, the bad news is that September is the worst month of the year, but plenty of news, as I've kind of indicated, to balance that out. Why is September the worst month of the year for the Dow, the S&P, the NASDAQ, and the Russell? While momentum usually overrides seasonal concerns, September is hard to ignore. It is the only month down on average. It is what it is for however it is. People get back to their desks. The traders are dusted their put away their rosé cups from the Hamptons and the Muskokas of the world. But the last 4 Septembers have been particularly ugly. September is the only month that has been lower in each of the past 4 years. So talking about the S&P 500 in September, and I'm rounding these numbers, 2023 down 5%, 2022 down 9%, 2021 down 5%, and 2020 down 4%. So, one could argue, Chad, why didn't you prepare for this? Why didn't we go to all cash? You can't go to all cash. As reversion to mean theory would suggest, Murphy's Law would also indicate that the first time you ever did that, aside that there would be massive tax implications and slippage with respect to bid-ask spreads, cost to trade, etc., things can change. But the elections are another wild card. Many traders believe the outcome will not be known for some time after the November 5th election, adding a layer of risk to what is normally the start of a seasonally strong period. I do think, as an aside, I think Santa Claus comes this year. I have a few charts. I don't think I can show them on the screen, but happy to discuss them, and maybe perhaps I'll circulate a private note. But talking about some of the overlaying seasonal weakness along with electoral cycles, this choppiness is real. So much like when you're on a big long plane ride, there's points within the journey that the pilot tells you to put your seatbelts on because you're expecting turbulence, but turbulence is normal. The good news outweighs a lot of the bad here, though. Seasonality aside, the market is riding a wave of momentum, and with good reason. The market broadening trend is very real. 2/3 of the S&P 500 was up in August. The New York Stock Exchange advanced decline line hit an all-time high, and more than 70% of the stocks in the New York Stock Exchange are above their 200-day moving averages. More importantly, and I alluded to this earlier, the equal weight S&P modestly outperformed the S&P 500 in August and closed Friday at a historic high. Megatech did not have a bad month, but aside from Meta, it was not the leadership group. So earnings remain strong and corporate profits are at record highs. That is the single most contributing beta input into the return of a stock market over a long period. And interest and corporate profits are high and money supply is easing up. So earnings topped 13% growth in the second quarter and is expected to remain strong for the rest of the year. So 2024 S&P earnings still strong, big check mark. Q2 they were up 13%. Q3 estimate 5.7. Q4 estimates are very bullish at 13.5%, and 2025 estimates are 15% growth to earnings. These numbers have not changed appreciably in several months. Number three, sentiment is bullish, not as wildly so, but the weekly poll of members of the American Association of Individual Investors indicates bullishness is at 51.2, and it's above the long-term average at 37.5. But that's mostly because a chunk of people who are neutral have become a little bit more optimistic. Bearish sentiment is not too far off from a historical average. So bulls versus bear, we've got 51% bullish on an average of 37. We've got 21% neutral, where its average is around 30, people in the middle, and 27% are bearish, when on average it's about 31. It's usually about if people are naturally bullish, so averages are 37. So we still have a bullish investor base. And number four, inflation is waning. The July core PCE and the Fed's preferred gauge of inflation dropped to 2.5%, within the reach of the Fed's 2% inflation target. So is the Fed put back? Another important support for markets are Fed rate cuts. They're expected. Recently at Jackson Hole, Chairman Jerome Powell made it very clear that the Fed had shifted its attention to fighting inflation to the job market. And according to FedWatch, the vast majority of traders, almost 70%, believe the Fed will cut in September. That's about 70% say they'll cut. 32%, potentially up to a 50 basis point cut is possible. So it makes sense that most traders don't think the Fed needs to be very aggressive yet, with the job market still relatively strong. And most traders don't expect the Fed to get aggressive unless it has to. Here's why. Like, one would say, get the economy going. Just remember, the Fed and central banks, they cut rates to stimulate the economy when you see a rolling over and a weakening of economy, which spurs investment and a new job cycle. So I'm a little concerned that if they did something more aggressive and they did 50 basis points, because I'm concerned that maybe market participants may view that as the Fed seeing something scary in their economic data and are moving more aggressively to get in front of that. So you don't have to give all the candy all at once. Still, most market observers believe that any sign of significant job deterioration will likely be met with more rate cuts from the Fed. So this belief in a Fed put is helping support the bull position through any sell-off around job deterioration, but it'll be short-lived as the Fed is helping put a floor under the market. NVIDIA was in the news a lot. It got smoked the other day, lost almost 10%, which is $240 billion of market cap in one day. This stock, it's still been a winner for portfolios, but it went from a peak of 140 down to 90, back to 107. That is absolute small cap volatility in one of the largest companies that makes up the S&P 500. So some key takeaways. After recession, it's about rotation. There's seasonality, positioning, liquidity, and sentiment. So we're being careful about chasing stocks that are above their end of year targets in relation to that of their peers. On the top of the tactical risks, the probability of recession it's rising given a slowdown in G&I, but household consumption is fine and it is booming. So there always is that risk of a household consumption experiencing a sudden stop if psychology changes, and that could be in and around the electoral cycle. But such an event is difficult to predict with certainty. So regardless of what happens in the real economy, and we're talking about all this AI is all the mania camp, it's unlikely to last. And regardless of whether a recession occurs or not, our view for long-term investors that a rotation is afoot. And we saw that with an initiation of material position in international stocks, excluding the US and Canada. So there is no World War III yet, and deglobalization has stalled. And AI is essentially a better paperclip at this point. As such, we don't have to hide quite yet in America. We have seasonality to be the headwind for the next couple of months, but very comfortable that all allocations made in deployment through this last kind of a phase through an easing cycle of money supply is going to be a boon for client portfolios over the next 1 to 3 years. So again, thematics, we have tailwinds of an easy money supply and accommodating Fed. I do believe Santa is going to come big time this year, broadly speaking. Still a big proponent for equal weight and our exposure into the U.S. economy, and international names taking on a larger and larger focus. So, buckle in for the end of the year. I hope everyone had an incredible summer. And just remember, all of this is normal. Turbulence is on its way. But that's okay. Lots of engineering has gone into the construction of portfolios, and a lot of expertise has gone into helping clients navigate some seasonal uncertainties and chops within the market. I hope you guys have a wonderful September. I look forward to seeing and speaking with many of you. Have a great month, and we'll talk soon. All the best. And as always, any one member of the MLD Wealth team is available to have discussions with yourself, with those that are close to you. So as these uncertainties wane, feel free to call myself, email, send a messenger pigeon or a smoke signal. We're always here to talk about markets and how it affects you and how it affects the capital and how it affects your savings. Thank you so much for the pleasure and the opportunity to serve you. And we'll talk soon. All the best.